Good evening, all. Let's wait for some minutes. I'm expecting more to join, so let's wait for a few seconds more. Let's begin. Last session, we are discussing about promoters. We were talking about role played by promoters, and the importance why the disclosure of promoter is essential. We talked about the case study. Then let's talk about the clause. The clause F we discussed about holding. Now let's talk about clause I. The clause I denotes for the period of 5 years, immediately preceding the date at which the balance sheet prepared, it is aggregated. The number and shares are fully paid up without payment being received in cash. Number of class of shares allotted as fully paid up shares are bonus shares, and aggregate numbers are share bought. Now, to just remind you what are the clause, these clause are a continued control about the holding pattern of shares, about holding pattern of rights to vacant decision, and the controlling of organization. So the first clause I, it talks about the holding of shares and issue of shares, whereas the clause F of 6A talks about how the ownership is involved. For example, if I'm owner of a company and I'm a promoter who has just started the company, in such case, I need to have the disclosure of my ownership in my company and in my subsidiary company. So that disclosure about holding company and the membership or rights in subsidiary companies is called as clause F. So as per this clause, it is essential for me to disclose the ownership, the voting rights, benefits received, and the role played in the other countries, so other companies, which are subsidiary companies to my major stakeholder company. Now, why this disclosure again required? Because when I am member of the one company and if company is holding majority share of subsidiary company, then ultimately I get an authority to become member of subsidiary company. So again, authority of ownership is automatically received for me. So in that case, as per clause F, I need to also disclose my holdings, my control in subsidiary and other companies, and stating the rights and benefits which I have enjoyed as promoter. Similarly, clause I note 16, it talks about the allotted shares, paid up capital, value of same, and bonus shares or right shares given to the promoters. Now, what are the other disclosures? The other disclosures regarding promoter are disclosure about convertible securities or long-term assets. The other disclosure is about unpaid capital because when I'm a promoter, whatever the portion of paid and unpaid capital, that disclosure is very essential in any balance sheet. Before moving to the result surplus, let me show you the example of promoter. So this is the balance sheet of Bajaj Auto for year 24-25. Let's find out promoter. So here I'm not getting the word promoter. So let's jump on their disclosures. Now this is details of their shares. I'll just zoom it for reading purpose. So in Bajaj Auto Capital, the actual balance sheet, they have disclosure about the shares, their holding pattern. We'll just scroll down. They have details about listing of shares, market price of share, and this is distribution of shareholding, what we are discussing. I'll wait for a few seconds. Just read this slide. I'll zoom it for your more reading. So if you see the distribution in Bajaj Auto at actual, the promoters are having total in Bajaj Auto, the promoters are having total 55.04 shares. The foreign investors they have 10.61, mutual funds 6.54, the banks has 0.05, and others are 0. So we'll find out the NRIs has share of 0.72 and others has 26.04. So when I talk about the shareholding pattern of Bajaj Auto, 55% shares are owned by promoters. Now this promoter is consist of four families of Bajaj and their family members. If I talk about the shares again, the shares which are owned by the Bajaj family, they are 153,000. 153 lakh 708,367, whereas the contribution made by others is only 69,000, sorry, 6 lakh 90,000 2100, sorry, 6 crore 90 lakh thousand 21,510. So comparatively, the contribution by non-promoters is very small. Why this disclosure required? Because this disclosure will give me idea about holding of shares of company and help me understand the pattern of working. So earlier the ratio of promoters was 55.06 and now it is 54.04. It means there is a reduction of 0.02. If I talk about ratio of FIs, it was 14.52, which is changed to 11.61. So approximately there is change about 2.5%. The mutual fund, the investment has increased. So here we find the positive change. The nationalized and other banks, they are having more investments. NRIs, they was having 68. Again, they are more. So they have positive investment. And others from 24, they are moved to the 26. So this is the change in holding pattern. If you see the actually, the total capital contribution is remains same, but division has changed. The value of capital remains same. That is 27 279 lakh 257,608. And if you take it on 31st March 2024, the shares are less. The indicates the company has some clear shares. For example, 2,79,279,257,608 was shares. This number is common, but from here onwards, you can find out the share capital is reduced. So this is promoters holding display in Bajaj Auto. I'll just remove my workings. You please go through the pattern of disclosure. Let's move on. If we scroll down further, they are given the categorization based on number of shareholders. So majority of shareholders of Bajaj Auto, they are 1 to 500. Their percentage is 9 and 98.07, whereas shares in this class are around 2.30%. Majority of Bajaj Auto shares are held by the people having 10,000 and more shares. The percentage is 93.16%. And so we witness the holding pattern of Bajaj is a serious question because majority rights, benefits, and decision-making authority is with owner itself. They are not segregated or reallocated towards the different members. So altogether, this pattern of different holdings will clear the doubts about the cost of capital, their structure, and their pattern. Let's move on. These are the certain additional declarations which need to be done. So here is summary. So here they are further disclosing the outstanding shares and so forth. The number of shareholders who are not yet paid are two. Their total outstanding shares are 1310. The number of shares which are approached for company transfer are two, but number of shares are 155. So this way, we can find out number of shares which are unclaimed and in suspense account are 12,635. So let's explore what is more in balance sheet. I'll reduce the zoom for your reading purpose. We're not interested in nomination. Let's go on declarations. So this is a declaration which is essential in balance sheet about the promoters. Now I just zoom it for a reading purpose. The Neeraj Kumar Ramkrishnaji Bajaj, he is non-executive chairman. It means he is actually working in company but not active. Then we have Raviyan Rajav Rahul Kumar Bajaj, second Sanjayan Rahul Kumar Bajaj. Now Neeraj Kumar is a different person, whereas Rahul Kumar Bajaj is a different person. And this Rahul Kumar has two sons involved in Bajaj Auto. One is working as managing director and CEO, and second is working as non-executive directors. If you see the other teammates, you are not getting any Bajaj. The other teammates are Pradeep Srivastav, Rakesh Sharma, Nausad Forbes, Armani Pradeep Shah, Abhinav Bindra, Vinit Bal, Sangeeta Reddy. So, as per this, there is about selection and rejection of director. So, when any director is selected in a particular year, or when any person is nominated for selection of director, they mention the name of the person, and that person need to obtain the electoral votes or board of directors for continuing to next year. Along with this, the two-third voting rights are need to be passed in his favor of general shareholders. So this is the board of directors, and we can appoint the rotational board of directors as and when it is required. If I just scroll down this balance sheet, here is our format of balance sheet. So let me just show you. Yes, this is what we are learned as a balance sheet. Let me zoom it for your purpose. Please read the contents and I will wait for a few seconds, then I will explain it. Now, I think it's visible. The first thing they mention non-current assets. In that first item is property, plant, and equipment. Second, capital and work in progress. Third, investment property. Fourth, intangible property. Fifth is intangible assets under development. So till here, the regular assets, which are short term, to be extended long term, are mentioned. Then we have financial assets, that is investments, loan, and other financial assets. We have income tax assets and other non-current assets which are mentioned. So this is fixed assets shown in a balance sheet. Please once again go through this. I'll just zoom it for the name. Please read the names. Now, if I see the list of all these assets, one thing is pretty sure. The first importance is given to fixed asset. But where you find the depreciation? Let me zoom out. Just compare. There is no depreciation. Then how the depreciation is actually being recorded? Anybody? No further explanation is required. So we'll just scroll down. Here in current assets, we have one new item. Let me explain that. The bill receivables from any business or bills payable, they are called as trade receivables or trade payables. Normally, the word bills payable or bill receivable is avoided in any balance sheet. So, the current assets consist of inventories, financial assets such as investment, trade receivable, cash and cash equivalents, bank balance, loans, other financial items, and other current assets. So I'm unnecessarily not again explain these points because we know these contents, and we'll learn a lot time the meaning of this. Only new thing is trade balances. The is bill receivable. So let's scroll down the for the if we scroll down, it is clearing about equity and liability. Then non-current liability. Non-current liability are those liabilities which are long-term in duration and taken for a long period or for a subsidized period. So after non-current liabilities, we have current liabilities, which are nothing but our short-term obligations to settle the payments, to settle the loss during the trade. So when you talk about the current assets and current liabilities in book and current assets and current liability in a balance sheet, they are totally different. In case of fixed asset, the depreciation is charged separately in accounting disclosure in balance sheet. But while showing the balance sheet, they show the deprived assets, avoiding the misjudgment by deductions. So let's explore what is the about promoters. So these are more revenue expenses and other details. Let's understand the other things of the Schedule 3. So let back come to our PPT. Those who remember what is reserve and surplus, please put in chat box. Now, if I talk about reserve and surplus, they are the portion of my profit or income which I have kept aside. There are two types of reserves. One is revenue and second is capital. When I invest or when I keep the portion of my profit for long-term investment, for replace of my assets, for replacing my long-term heavy bulky projects for its relocation, redevelopment, or union, then I need to create reserves because all of a sudden, if I meet with this kind of financial obligations, then in such case, I may be suffering from a loss. To avoid this, I always mention some reserves. The general reserves are used for companies' upliftment, whereas capital reserves, these are alternate source for funding the reserves. We can use the revenue reserves in capital reserve, but use of capital reserve in revenue reserve is not allowed. The simple reason, the commanding factor, the growth and history of that particular place or public, which is having a great tradition or background to follow. In case of surplus, it is excessive things available, but whereas reserves, these are the shortest thing possible. So we always write reserves and surplus. The S attached denotes the multiple value denominations and it always plays a vital role in port. So let's move on to the other. If in doubt, you can just put in chat box. Let's understand the types of reserves which are mentioned under Schedule 3. The first reserve is capital reserve, which is used for payment of dividends. Second is capital redemption reserve. Now, capital redemption reserve is used for redemption of capital, that is repayment of any capital assets. The securities premium reserve. Now, the first two reserves we create, but the securities premium reserve is not actual reserve. This is an additional amount paid by subscribers of the security who has owned the securities. Then we have debenture redemption reserve. Redemptions means redeem, that is repayment of the thing. Suppose I have 5 years debentures, 10 years bonds, then I need to pay after a particular period with interest and other things. And in that case, I need to maintain the reserves because if I do not maintain the reserves, it will create an impact or my financial feasibility and my working capital will be challenged. So these are certain reserves which are permitted under the Schedule 3 of Indian Account Standard 1. So please go through this. If any not clear, just put the name in chat box. I will explain that. Please go through these reserves. Most important, these reserves are not expenses. All these reserves are simply provisions which are made. These reserves are a precautionary process where the future expenses are being thought and they are being counted in a particular way so that the immediate expenditure pressure will not be there. And the people at large, when they're investing in company, their records and their declaration has taken care. So here securities premium is extra amount paid. Okay. The most important reserve is revaluation reserve. The revaluation reserve is created basically when companies are going in financial distress or when companies are progressing in future. In short, the revaluation reserves are those reserves if companies expanding business and they are either entering into joint venture or take over to expand the horizon of that business. And hence they are called as revaluation reserves. This loss or profit of revaluation reserve is transferred to the capital account for the following financial year. Actually, in revaluation reserves, we take care in appreciation or deflation of price of related securities and their growth. So let's move further. Shares option and outstanding account. Now, shares options is also known as stock options. What is stock option? Stock options are that part of shares which are converted into warrants and issued as and when the policy of company disclosed. Now, what is different between shares and warrant? In case of shares, I cannot easily pay or sell things, but in case of warrants, I have opportunity to present the shares to the company and I can just get the money back. So in case of shares, the distribution is happen on the basis of bonus shares, right shares, and I need to issue the declarations to the SEBI board of directors and all the shareholders by a separate disclosure. Permission is required. But when I convert the shares into warrant options, I will trade them as share volumes as stock options. These stock options are having undertakings the participation benefits, but they cannot claim the dividend as compulsion. In many organizations, stock option is a strategy to motivate the workers, to motivate the people as their loyalty bonus. Because under stock option, I can share the profits of company, but I cannot claim the right or the asset of company. Now, what is different between share the cap profit but not right? In case I share the right of profits, I can claim my voting that I can be a yes, I'm agree, yes, I'm not agree, okay, I think so. So you can make your remarks. But in stock options, the person is only enjoying the benefits. But if suppose company is liquidized, it has a loss, then in case of only shares, I can claim the possession or the liquidation benefit out of shares. But if I have stock options, I'm not actually holding shares, but I'm holding the derived value instrument, which give me only the right to contribute as voting right. And second, I'm holding the contribution in company share as valuable assets. So stock options can be traded. They can be used for profit sharing. But unlike shares, the freely trade of stock options is not allowed. Again, stock options can be operated and used in selected formats. All the stock options is not allowed to list in all the stock exchanges. They are bifurcated under volume, trade, product, and size of operations. Larger the size, larger the size, larger investment options available. But we have seen mostly in India, the stock options are official claim documents where instead of selling outside, the companies take this as their liberal policy to motivate their managers for more and more potential growth. Now, let's talk about surplus and deficit, that is balance of settlement in profit and loss account. Just go to slide. Now, when we have balance sheet, let me explain this with the format. Suppose this is my balance sheet. If the surplus is on debit side, then it is called as, just a minute, more expenses. But when the surplus on credit side, it is called as more income. So when I have debit side more of a profit and loss account, then we know that on debit side, we record the transactions, we record the expenses because the statement of profit and loss account is works on nominal account principle. Now, what is nominal account principle? As per nominal account principle, debit the losses and expenses and credit the gains of income. So, whatever the loss, whatever the expenses we are going to make, I have to record on debit side, and whatever the incomes, I have to record on credit side. So, when I am creating some reserves, even though it is not actually expenses, but it change its custody, it goes to the new person, the ownership and recognition also change. The reserves and surplus are the excess amounts either on debit side or credit side of profit and loss account. If the amount is extra on debit side, then in this case it is considered to be a loss, but amount on credit side is more, then it is considered as a income. I hope I'm clear. Let's move on to the next slide. Other reserves. I'm not covering this other reserves. Okay. Why not cover other reserves? Because this is only possible in case of technical paper, but the approach of your project is very friendly. And as per this approach, we don't require this other two type of reserves. Let's talk about money receipts against share warrants. As notified to you in last session, Warrant is an dividendal check which is given to the investor that at so and so date you can just open the vault and collect your money. The warrant is indication of short-term fund arrangements either for capital or working capital needs. The financial instrument which gives a holder to acquire the equity shares. So, like a police, why I'm saying police, not actually police, because when I give an example of police, we understand the things more factually and correctly. So, money received against warrants is a call money. I just present this instrument and acquire the refund. So the first money received against warrants has option to convert it into instrument or to convert it into shares and get the redemption benefits. So the importance in financial instrument of dividend warrants, they are either source or application of investment activity, where apart from others, the shareholding and decision making power is separate. So warrants, when we issue to the public, we receive the money. It's called money received against warrants, and we have to record these transactions as a financial instrument which consists of allowed limited viability in capital structure. Yesterday, when I was explaining the capital, at that time I explained this concept that I never issue the all available capital to the market. What I ensure, the part of capital is authorized, part of capital is subscribed, and part of capital is paid up. In short, the application money is the cost which people pay for purchase of shares. This application fee can be understood better way if I call this as commission or if I call this as brokerage. So the application money is the price which the customers or future investor is ready to pay for allotment of shares. Whereas in this case, the application money is added to the value of shares, but the allotment means giving the number of shares. Suppose I have 10,000 shares and 20,000 people subscribes, then it is called oversubscription, and this oversubscription may limit myself for purchase of number of shares. So let me give an example. I have total 5,000 applications and available shares are 10,000. So it has enough shares to give each member. So 5,000 and 10,000, if I calculate proportionately, I can easily understand. In this case, my one share can have two allotments. So I can plan accordingly and I will decide the capital structure. So share application and pending allotments, these are essential crude documents of a balance sheet. But since the age group of respondents, we need to quantify and qualify these documents and the secret buried under that. If in case the share application money exceeds the amount of share, then this application money is termed to be not core part but considered separately brokerage accounts. It is at company's purview and existence whether they will go on outstanding or shortfalls. If the outstanding or shortfalls is assumed in allotment or application money, it is considered as discounts. Please go through slide. Let's move on. So these are the examples of non-current liabilities. Please go through this. Let's elaborate and discuss this more in detail. There are two types of borrowings. One is long-term and second is short-term. The long-term borrowings are classified as for longer duration and they are used for settlement against the capital investments, whereas short-term borrowings are tentatively for revenue nature from 1 to 12 months or as deferred from 1 to 18 months. The major plus point of long-term borrowings that sustainable and socioeconomic returns are generated. If I'm too high and hectic and taking more risk about profits, then in that case, the borrowings will be more unstructured and they will be having advantages of large amount but number of less people. In case the long-term borrowings, they normally being quantified less, the rate of interest is average compared to the other lendings. These long-term borrowings facilitate the promoter, the board of director, and the organization at whole to control and regulate the flow of money and avoid the over duplication or unstructured, unreported data for use of borrowing decisions. I'll wait for 1 minute. Please go through the slide. Now let's further proceed. If any doubts in long-term borrowing, because why I'm taking a pause and asking you to read, because these are already discussed, and if I go on more and more same repetition, it will irritate to your sides. Okay, this is something new. Current maturities. Now, anyone know the meaning of maturities? Even though I mentioned on slide, maturity is a stage where I have surpassed the basics and advanced combinations I'm using. So current maturities are long-term borrowings which are disclosed as short-term borrowings or current maturities. So please remember, maturities is an alternate word the companies or industries they are using to recognize the current liabilities, and in current liabilities they are understanding the short-term disclosures for any accounting purpose. The word accounting is very generous and hence disclosure to the current maturities, that is short-term liabilities, is very crucial and it is categorized as borrowings such as loans and debentures as per the amount and relations. Now deferred liability we already covered. If it is up to 12 months, it's a revenue. From 12 to 18 months, it is called deferred. And similar way, we deal in this. Now, what is trade payable? Trade payable is an simple name of bills payable. When we are dealing on credit, either we give the assurance or the supplier will take the assurance from buyer about the guarantees of their money. If it is guaranteed that money is in excessive available, then the person will take the lead and maintain the trade payable in such a way that it will not affect the company's overall policy and follow the full disclosure discussion about security and valuation. So trade payables are classified the specific activities or processes where we are giving the document, we are giving authorization so that instead of paying cash, instead of making partly or fully payments advances, we are simply giving the bills payable. So in our books, we called as bills payable, and in practice, it is recognized as trade payables. But overall, it is same features and constraint. So this is dispute agreement, so not part of syllabus. So I click it. Now, what are the disclosures which are required to be made by micro, small, and medium enterprises in their total pricing? As per this, the principal amount and interest due should be thereon mentioning unpaid by supplier. Second, the amount of interest due and payable for the period. Third, amount of interest paid by buyers and amount of payments paid to the supplier. So first point talks about the capital block. Second point talks about debtors and creditors. And the third block, it simply discuss about outstanding bills payable or bills receivable concerns. In the last, the amount of further interest due to payable even in succeeding year is considered as the amount actually paid to MSME as their expenditures in trade promotions. So the overall expenditures and their disclosures when we are dealing with MSME, cottage industry, or small scale businesses or small scale activity houses, we need to ensure the disclosure of interest, amount, and returns which are generated. Now, what is meant by long term provisions? If we are setting aside some part of capital to use for future references and benefit, this future reference and benefit capital is classified as provision for employee benefits and others. Now, employee benefits are further classified as monetary and non-monetary. So we're showing this. Then let's talk about the other content of balance sheet, that is short-term borrowings. The short-term borrowings are classified in variety of ways. First, they are classified about the domestic or international. Second, it is classified based on the value of asset which he is having. Third, the short-term borrowings are specifically regard to compare the reserves and bonus, ensuring smooth operation of that particular organization. So short-term borrowings are classified by banks and other parties. They are classified into local currency and global currency. Short-term borrowings are classified as risky and non-risky. So in short, the short-term borrowings are the source of application of funds for certain period for either correction of balances or to enact the new developments. But the short-term borrowings is having advantage over long-term borrowings because these borrowings are less tax. Their assessment is having self-declaration with ITR 3 or ITR 6. They are not valued as salaries where the proof and evidences are mandatory. However, it is understood that in short-term borrowings, the risk profile, the returns and rewards are compared to less than the long-run borrowings. Please go through this slide. I'll wait for a few seconds. Done with reading? Any doubt? No doubts. So let's move on. Now, okay, thank you, Aishwarya. Let's go directly to the other current liabilities. Please go through the list of current liabilities. We'll discuss one by one. Now, the first is current liabilities, where the lease and obligations are there. Now, what is meant by lease and obligation? Lease is long-term loan which is given under the consideration that the asset is not transferring the ownership, but the asset is just giving a position for revenue generations, and it is more flexible and more beneficial. So, lease is the agreement where we observe that more and more shifting the focus of transfer to an long-term gain. Now, if I purchase or sell assets, there are certain taxation, certain applications, and certain limitations we always face because the fixed assets require registrations, fixed assets require coordination and repair maintenance. So, if I enter into lease agreements, these obligations of maintenance or concerns are transferred to the person who are using it. Second thing, lease are classified as simple loan agreements where the person is giving the assets, holding, or any other thing on a loan. The financial lease is normally of more than 25 years and above. These leases are intended to deceive the tax load and any other application charges what the owners or the contributors are going to feel about. We'll discuss the other current liabilities, then what short-term provisions, and then we'll go to the asset part. So that's all for now. Today we discuss about the liability side. We discuss about short-term liability, long-term liability, their contents, their valuations. In tomorrow's session, we'll discuss about, sorry, yes, on tomorrow's session, we'll discuss about more about assets, and then we'll finish our first unit after discussion of assets. Once our first unit is finished, I'm going to share a small MCQ test online. All of you need to express in Google Form. So thank you for being attending this meeting. Now you can log out from the meeting and join the common subject session conducted by Dr. Anand Padai. We'll meet again at 8 p.m. for same. Now you can log out. Now you can log out, all of you, and join the next session. Still, there are many students. You can just log out, join the other session.